Decades of U.S. monetary policy getting ready to come to a head, and it doesn't matter what the financial advisors are saying. Stay tuned and find out. Welcome to the Wealth Transfer. My name is Terry Saka, and I do want to let you know right away that if you have the ability to record, I would hit the record button on this program today. We're going to talk about decades of U.S. financial monetary policy, and as it comes to a screeching slam into today's active market. And you're going to want to see it. You're going to want to review it. And this is something financial advisors are going to have a hard time to get around, folks, because they're more short-term, the quarterly ROI, the annual ROI. But when you see what this data is compiling and how it's leading us to this epic confrontation, you're going to want to have a base of a diversification. And don't let them tell you diversification is in paper in the market system. So just keep that in mind, because we don't want to be all in the paper titleless world when you see what's getting ready to come. So I just pray that the Holy Spirit is loosed into this program, that eyes and ears be opened. And yes, we do all miss Pastor Charles Vance. We did move our studio out west, and it's made it a little bit more difficult for Pastor Vance to be with us on the program. But we have been talking. I would like to have him out. I do miss his biblical insight on things, so we will do that from time to time, and we'll let you know. But go and bless Pastor Vance if you can. Go to Empowered Television. They're just wonderful people, and they're the ones that got us into this in the first place. And realize the importance of bringing this information to the people. And another thing before we get going, I want to mention is the wealth transfer was about the transfer of the wealth from the wicked to the hands of the innocent. And that goes into Job 27. This is never about economic collapse. It's not about fear. This is about, as Joseph did in Egypt when he had 7 years of preparation. We just so happen to be at a time, an epic period, that something is coming that we probably have never seen before and probably will never see again. I think it's just decades of accumulation of just policy in this fiat world that has to come to a head, and especially with Emperor Xi now in China flexing his muscle. Folks, it is coming. And with China and Russia backing each other, there will be a reckoning. You will see it soon, and it's so important that we, at least in the kingdom, become diversified. So I'm going to go right into it. For those by now, hopefully you hit the record button, so let's just jump in. And this is the first image, called the U.S. monetary policy from 1979 to 2017. Now, this is not going to be dry. This is going to be something that if we dig in and just focus on the detail, the bigger picture will play itself. But notice, going back to 1979, where the average interest rate was around 10% on the left, then 4.8%, 1.5%, and then, of course, where we are on the right now at 0.5%. Now, if you notice, within the right side where the blue is, that is during the Ben Bernanke time, we had done extraordinary amounts of money printing. We had QE 1, 2, and 3. We had an Operation Twist. We have literally printed up $3.76 trillion into the float. Now, folks, if you just think of cranberry juice and you pour cranberry juice into a bucket of water, it's predominantly going to remain red. But when you put cranberry juice into an Olympic swimming pool, it's going to basically dissolve itself, and you probably won't even see it at all. We have really dissolved the American dollar to such a point today that it really only has about 4 cents on the dollar for buying power. And the key here is buying power. What does that dollar you're holding, you're saving, and you're investing actually do for you? This monetary policy going back to 1979 shows that the interest rates have steadily been coming down because they have to. Interest rates are kind of correlated to the debt that we hold. So as the United States government continues to increase its debt to the tune of trillions today, when we increase interest rates by a quarter point, we add $50 billion in interest payments alone to our debt. Now, folks, we cannot sustain it. I know people say, oh, we got to do certain things right now in business because interest rates will be rising. They have to raise the rates right now because if you've noticed that last image, raising rates always seem to correlate right before they had to lower them because of recessions. They cannot go too high. If we raise interest rates just to 5%, we will be spending $1 trillion a year on interest alone. And we just can't afford that as a nation. We're spending $1 trillion on welfare annually. Now we've increased our military budget, which is truly the only real thing government should be doing. And that is shy of $1 trillion, and yet we only make about $3 trillion or so in tax revenue. And mind you, tax revenue is at the highest we have seen, and yet we're going down in our deficits, or actually we're raising our deficits. This image here is the U.S. 10-year from 1980 to 2018. Now, if you've noticed where it goes from the left, that is the 70s, the Volcker time frame, when many of you will remember 19% interest rates. And then, of course, it's been steadily decreasing. Now, some people may think lower interest rates is a good thing. The problem is lower interest rates are only low because the economy isn't doing so well, and they need that to stimulate. And if you notice on the trend line, we have epic periods of the 10-year yield from Black Monday, the S&L crisis, all the way over to the right where they call the Great Financial Crisis and where we are today. The blue line is the actual interest rate, and then the red line is your 10-year yield. Now, what is really important here is the 10-year yield is creeping towards that 3%. Now, I'm not a big fan of saying charts are predictive, then therefore, but they definitely give you some patterned history as to what is probable and probably likely. But the fact that we have broken that trend line means we are getting ready to see something coming, because as these interest rates rise on the 10-year yield, which is our bond, there usually is a stock market correction. And folks, this time around, I don't believe it's a correction. I believe it's going to be an epic reset in valuation, because there's a lot more to it than just the United States economy. This is Europe, and this is Russia, Syria, China, Taiwan, the petro yuan, and this epic East-West clash of power, because the United States has a hegemony, which is really a global dominance, and we're trying to prevent, which is already too late, the Chinese and Russians for having a stake, let's just say, in global affairs. The Chinese are already puffing. Emperor Xi is in place until he dies, and he's ready to show what China's really made of. And so what I'm going to do is take a quick break before we get into the next data, because I want to break it down so we can slowly understand the impact it's going to have. So until then, let me just take a quick break and let's go right back into it.
Terrorism, a volatile stock market, rising food costs, natural disasters. Every day our economy is at risk, but your assets should not be. Cornerstone Asset Metals is here to help you protect and preserve what you have worked so hard to gain. Whether you have IRAs to protect, 401ks to preserve, or cash in the bank, our accredited asset management specialists are here to support you. Call now and we'll send you urgent information regarding changes to the dollar and challenges to our economy that you need to be prepared for. Learn how easy it is to roll over your current IRA or 401k into a physical precious metals IRA. We can even arrange to have your precious metals stored in a private vault or send it directly to your home. Do not delay. Call 888-747-3309 or register online at cornerstoneassetmetals.com today. Invest in precious metals and create security in your future today. Call now.
Welcome back. Now, before I get into this budget deficit and surplus as a percentage of GDP, what I want you to look at is notice the gray shaded areas. The gray shaded areas are recessions. But what's unique about this, let me just put it up now for you. What's unique about this is the deficit that we hold typically comes in off the heels of a great recession or a depression of some kind. Even though we only had one depression, I think you'd be surprised last time it was as well. But look at where we are on the right. Now, we've come off of the gray shade there on the right, which is the epic 2008 market collapse. And of course, we had a tremendous deficit at the time. But notice the last three cycles here. The years are deteriorating budget deficits without a recession in front of it. And with the new tax cuts they did, and which many are enjoying, with the new tax cuts, you're noticing that there's not this cycle, this typical cycle that comes in with cleansing the market, which would be a recession. With those tax cuts, we are going to see even a larger deficit. Now, I saw a piece the other day that explained it very well. We are borrowing money from China, who has become an enforcer on the eastern seas, just to enforce, like, let's say, immigration. And we spend literally 150 billion a year in illegal immigration, let alone the state of California. And so we're borrowing money to fight stuff that we shouldn't even be dealing with. And that's why I think it is so important to have a very focused and strong immigration plan, and why the wall and controlled immigration through that is an issue. But I only bring that up because that is a lot of money. But if we are going into systemic deficits deeper and deeper off of borrowed money from China, what does the Bible say? Of the lender to the borrower. That's right, you become a slave. So this is a real chess match taking place right now with President Trump and Emperor Xi, I like to say, because they really can crash us in a moment by just dumping our treasuries. And yet, I think what really we're seeing right now, and Trump is a brilliant negotiator, but what we're seeing is who needs who more? Does China need us more, or do we need China more? And that's what you're seeing right now play out. I have a feeling because Emperor Xi doesn't have to get a re-election campaign started, he might just stand pretty firm to try to take down once and for all the United States hegemony. And folks, that is very important. So the fact that we've had 3 consecutive years of the budget deficit going down at a period when tax revenues have been increasing. So our government's been getting more tax revenues year over year, and yet we're continuing to rack up deficits deeper and deeper, basically getting in the hole. Now, for each of us as individuals, if we rack up all of our credit cards in times of good, what are we going to do when it's bad? And that's where we're at right now as a nation. And so as we're going through this decades of monetary policy, what I'm trying to outline is the deterioration of what our dollar used to buy us. Over these decades, we have run the course of the dollar's ability to be functional. So as we're printing a dollar, how much is it getting us? And it's decreasing to the point as we print, we're on the verge right now, as we print a dollar to stimulate, we are going to have negative results. And that's how you know a currency is in its last days and why we probably need a war to get through it. Now, just real quick for those that are kind of curious as to why there's an image of commodities behind me, because what I see in the equities being that they're so explosively overvalued, money has a tendency to move from equities into commodities during these periods for protective purposes. Commodities have been beaten down substantially. Silver has been taken to the woodshed for that matter, and these are phenomenal investments to hedge into while the markets are at tops and the commodities are at bottoms. Now, a few shows ago, I did outline that last year alone, the commodity sector had increased 40%. Now, think about that for a minute, because since President Trump has been elected, the market had gone up 40+%. Of course, it's retraced right now as you're seeing this extreme volatility. 500 points up, 1,000 down, 600 up, 800 down. That is an indicator, folks. Heed the warnings. Don't let the financial advisors talk you into no big deal, it'll pass. We are at an epic period of tremendous money printing and expansion. We are going to have a correction, but the correction number is the issue. And if they're trying to tell you, oh, 20% correction or so, it's going to be healthy, no big deal. Folks, that's not what we see coming. It's going to be a lot bigger than that. Let's go to the next image and I'll show you. The S&P 500 versus the United States federal total assets. Now, as of April 6th, 2018, the S&P 500 has inflated by 64%. Due to the U.S. money supply and money printing since the 2002 timeframe. Now, if you just look at the scenario to take place and consider that the additional impact of future rate hikes to play into this. But if you've noticed the blue and red line going all the way back to 2002, how it travels equally. As the Federal Reserve gets involved, and the money printing scenarios get involved, they typically line up with the S&P markets, but you notice where it broke. In 2008, we started to see a break, meaning we are seeing now the S&P at an epic high valuation compared to that of the S&P and the discontinued to the Fed asset ratio, which I'm trying not to make it complicated. Bottom line, the markets are so overinflated because of money printing and credit, margin debt. It's not real is what we're trying to say. And in order for that to correct itself and come in line with all traditional and basic economics, this market has to come down about 64%. Folks, think about your retirement. Think about $250,000 in a retirement account. If it drops 50, 60%, are you ready for another 10-year, possibly longer, to recover? Or is it best to be diversified, especially into the commodities sector? And the reason I'm such a fan of things like silver is because silver is so undervalued because of the manipulation. Even them on the Larry Kudlow radio show we outlined said that 200% back to the top is an extraordinary opportunity. And so we just believe because it's so liquid, it's just one of many in the commodities you would want to look to. But 64% just to come in line with the money printing and the real valuations of the stock market. You can't get around those figures, folks. The markets have been inflated. They've been taking loans out in margin debt and going into the marketplace. The first thing that'll happen when this market goes into corrective phase, and it's not now, and mind you, we're down 15% already from the high, which I feel so bad for those that are just now going into it. We've already shown that in the previous programs. But if you're just now trying to get into the markets, you may want to heed warnings and diversify because the ratios don't add up. And the first ones to the gate, you bet, will be ones closing out positions to get rid of margin, to get rid of loans, and try to go at least equal. if anything, if you're going to take a loss, take it at least 1-to-1. Meaning if you have an account of 100,000 and it's all just yours, then if you lose half of it, you just ride it out until it comes back. But if you're in margin, I highly recommend getting out of any form of margin or credit when it comes to investing, because you will be forced to sell everything at a time when the markets are declining rapidly, and you just may lose a major portion of your retirement, which isn't good. So I have to take a quick break, but let's do that and let's get right back into it.
Terrorism, a volatile stock market, rising food costs, natural disasters. Every day our economy is at risk, but your assets should not be. Cornerstone Asset Metals is here to help you protect and preserve what you have worked so hard to gain. Whether you have IRAs to protect, 401ks to preserve, or cash in the bank, our accredited asset management specialists are here to support you. Call now and we'll send you urgent information regarding changes to the dollar and challenges to our economy that you need to be prepared for. Learn how easy it is to roll over your current IRA or 401k into a physical precious metals IRA. We can even arrange to have your precious metals stored in a private vault or send it directly to your home. Do not delay. Call 888-747-3309 or register online at cornerstoneassetmetals.com today. Invest in precious metals and create security in your future today. Call now.
Now, I want to get into a few indicators so you don't really take the data from myself. And the reason we like to just use data here at Wealth Transfer, so you don't really have to take it from a talking head per se. Not that I like to consider myself a talking head, but we are here to just give data and information and let you digest that. But look at this figure that comes from Morgan & Stanley. Morgan Stanley developed Market Economy Cycle Indicator. And if you've noticed, going all the way back to the 90s, you notice the peaks, 1, 2, 3, and now where we are on the right side. That's right, folks. We have hit the same peak right now in 2018. Now, granted, indicators, I guess, can change, but if you want to go back decades of financial analysis, Morgan Stanley's telling you something isn't right, and it looks like we're getting ready to come into a major corrective phase. So, what we'd call it, let's just say this. Let's go into the, do you feel like you're missing out? A lot of us didn't get into the markets until later on because we were trying to be cautious, and we just get so antsy, we say, I don't want to miss out. Here's a bull market trend, and look at how unique this trend is. Now, it's called the risk of missing out. The final 12 months on an average account, 1/5 of the bull market gains. Now, this is a big deal. If you go back to the 2000 and look at the recession line and look at how many gains took place during that shaded area. Now, go into the middle in the 2008 timeframe and look at how many gains took place. The first one, 20% of it in the dot-com era. In the middle, the bull market was 16%. Folks, since President Trump has come in, the markets had gone up 45% from where they were. That's a lot. You're talking double any other last 12-month indicator. Now, these indications or indicators, could be off months here, months there. This is not the point. This is about the bigger picture. Something which is called money printing has been extraordinarily overdone to the point where the reset, you could say, is going to be epic in proportion, and why being diversified is absolutely paramount. Now, for those that actually like Warren Buffett, myself, I really can't stand the guy. The Buffett indicator, which is corporate equities to the GDP. Notice where we are. I just want to gather this out of this chart. Notice in 2000, when we're at 151 on this ratio, look where we are on the right in this ratio of corporate equity valuation versus the GDP. Yes, right back to where we were in 2000, meaning these markets are very overvalued. And when you start compiling these graphs and data points, you start to realize something is being told as a story, and your financial advisors can't get around that. Now look at this next one, which we call what every peak typically is followed by, which we all know what that means, right? First, we had the tech bubble, which was the 2000 stock market crash. And then we had the dot-com. Now, what is interesting about this indicator says when you're richest to when you're the poorest. And this deals with household net worth. So as our net worth expands during the expansions of economies, and typically falls with a crashing of the markets or the economies, and depending on how we're diversified, do we hold on to our wealth or not? But we are now at a peak on a trend line far beyond the last two market cycle crashes of individual net worth. This is the time to preserve and protect your net worth, period. The data is showing it's ready. Don't become part of the indicator that says we are now poor versus rich, and that's only in the matrix of what's happened during this expansion. Now, I want to leave with this particular image that is so unbelievable. Not that charts are always a foretelling, but check this thing out. It's the S&P, and it shows the 2018, 1987 market crash, and the 1929 Great Depression. Look at this. Look at how each one had expanded. If you notice, the green line is 2018, the red line is 1987, and the blue line is 1929, the Great Depression. You notice from left to right how the charts all increased, and that's the money printing, that's the expansion of the economy, and then it's pulled out. And then you have of course, right in the middle, the epic collapse. We've outlined this a few times, but we've already hit that point. It's about the 2580 range on the S&P, and we were showing on the Dow. And it's volatile. It's bouncing back and forth, but that volatility is an indicator. It's a screamer telling you we are at a peak point, and we could say peak economy point. But there's something else underlying in this. That are you ready to follow the same trend of 1987 and 1929? Folks, this is going to be a long one. And if it comes on the heels of war, which I believe it is, you may want to be prepared. I want to end it with this. New York Stock Exchange investor credit and the market. Look at the blue line diverge from the red on the right. So explosive, the credit, and those people will be rushing to the door first. Are you ready? So in the end, folks, God bless each and every one of you. Replay and watch this. Those images are just huge. And until next week, we'll get in again. God bless you.